by the name that we have been told that R, J, and D are partners sharing profit and losses in the ratio 7:5:4 respectively. The balance sheet as at 31st December 2018 was as follows. Buildings, as I want us to follow keenly. Buildings is 50,600. Property and equipment 26,800. Furniture 12,100. Inventory 49,470. Debtors 27,200. Cash at bank is 58 or 5,830. Or creditors, we have 15,450. Accounts payable, 12,350. Loans is 12,400. Capital account for her is 52,750. J, 45,250. And R, that 2,000. We continue. We have some additional information that the profit for the year ending that 1st December 2018 was 24,000. And another important information is that among these three partners, one of them died. That is, D died on the 1st of March 2019, and the partnership asset and liabilities were revalued as follows. Remember, this is an instance where we have been given the revalued figures. Some questions will just tell you that inventory is depreciated by 10%. Buildings appreciated by 15%. So you will have to do these calculations by yourself. But we are much privileged now to have our figures being done for us. We have inventories 40,000, furniture 111. We have in I think furniture should be not 116,000 but 11,600. Property and equipment 17,900. Buildings 57,000. Debtors 26,950. A contingent liability was recognized at 1,280. Another thing is that goodwill was recognized at 2,800 and D was to share. Note better that D was to share. And the share of D's profit for any incomplete year was to be computed on the basis of previous year's profit. Remaining partners are to share P&L in the ratio of 7:5 for R and J respectively. So we are required to prepare the revaluation account and the partners capital account and the new balance sheet. Let's start with revaluation account. On revaluation account, we have to know just little concept and we are good to go. One is on the debit side, we reckon any decrease in value of the asset and any increase in liability. I think that point is at home. If asset decreases in value, we reckon them on the debit side of the revaluation account. When liabilities increase, we reckon them on the debit side of revaluation account. When asset appreciates in value or increases in value, we credit them in the revaluation account. And when liabilities decreases, we still credit them on the revaluation account. So as you can see, previously we had inventories of 49,470, but they have decreased to 40,000. What do? We realize that as a loss or as a depreciation, and we have to reckon that amount on the debit side. Furniture from 12,100 to 11,600. So we have a loss of 500. Property and equipment from 26,800 to 17,900. So we have a loss of 8,900. Debtors, we have them decreasing. Remember that debtors are assets. They are current asset, and they have decreased from 27,200 to 26,950. So you have a loss of 250. And contingent liability, this liability was foreseen and it have automatically reviewed itself or it have happened. Now we have to reckon it on the debit side of the revaluation account, that is 1,280. On the credit side of the revaluation account, we reckon any increase in value on an asset and any decrease in has a decrease in liabilities, you can realize that buildings were from 50,600. They have appreciated to 57,000. So we have an amount of 6,400. So when you balance those two figures, on the debit side of the revaluation account, it is totaling to 20,400. But on the credit side, we have 6,400. So the difference is 14,000. That 14,000 is a loss on revaluation because it is found on the credit side of the revaluation account. I want us to note better that while this 14,000 was on the debit side of revaluation account, it could be a profit on revaluation, but it could still have been shared among the three partners, they included. So we'll share these laws according to the profit sharing ratio, that is 7:5:4. So capital account of R is 7/16 times 14,000, which is 6,125. Of R is 5/16 times 14,000, which is 4,375. D is 4/16 times 4,000, that is 3,500. Now the balancing, it balances at 20,400 on both sides. That is the revaluation account. Or it have been understood. That is the workings. So now we have another thing concerning the capital account. And since we have been used now to capital account, you know that on the credit side of the capital account, we record the balance brought down, that is the initial capital balances, and any goodwill, the share of the goodwill, we record it on the credit side of the capital account. And as you can see, on the debit side, no, let's concentrate on the credit side of the capital account. So we just reckon the balance brought down of the capital account on the balances of the partners, that is R 52,750, J 45,250, and D that 2,000. But concerning the goodwill, remember this goodwill should be shared among the three partners using the ratio. So this is our working, that is working one. We share the goodwill to R will get 7/16 times 82,800, that is 6,225. J will get 5/16 times 82,800, that is 25,875, and D will get 4/16 times 82,800, that is 20,700. We want to distribute that goodwill, the share of goodwill. We said B will have to enjoy 6,225, J will enjoy 25,875, and D will 20,700. Another thing, remember this is the capital account that each and everyone should claim. Any profit realized on partnership, any share profit should also be credited on the capital account. Now the question is, what amount of profit have they realized, and how will it be shared? First of all, we realize that the profit, that is, I've done it on working three. The profit, we've been told that any profit will be, so you realize this partner dined on March. So they had traded for 3 months. So we have to calculate the profit using the previous year's profit. So that is the previous year, 2018, the profit was 24,000. What about the profit of the 3 months? That is 3/12 times 24,000. That is 6,000. This 6,000, we have to share it amongst the three, so that D will also share. So we use the profit sharing ratio. R will get 7/16 times 6,000 is 22,625. J will get 5/16 times 6,000, that is 1,875. D will get 4/16 times 6,000, that is 1,500. So this is the profit that we are sharing. I'm sorry, that is the figure here on R is not 20. is not, it is 2625, not 26,250. Make some correction here. So you realize we have the R will share 2625. Let's hand for R 52,750 plus 36,225 plus 26,25, 91,600. No wonder I've said you just correct on the profit share. R will share 2,625. J will share 1,875, and R will share 1,500. And their balance is that 91,600 to R, 73,000 to J, and 54,000 to D. Turning on the capital balance or on the debit side, we say that debit side now will be recording the first of all the goodwill written off to R at J. We have written it off, as you can see, my working two. We've written the goodwill, that is 7/12 times 82,800, we get 48,300, and 5/12 times 82,800, get that 4,500 to R and J respectively. So you just reckon those amounts written off to R and J. Then we have what we call revaluation loss. Remember, if it was a revaluation gain, we could have recorded it on the credit side of the capital account. But since it's a revaluation loss, we have to reckon it on the credit side or the debit side of the capital account. We reckon 6,125 to R, 4,375, and even D. D, the one of the partner that have died will share the loss. That is the loss of 3,500. So another thing that we have to reckon on the debit side is the amount payable to D. You reckon in the column corresponding to D. That is the amount. When you look on this amount, you to get the amount payable to D, you consider the amount on the credit side, that is 54,200. You subtract the revaluation loss of that 500. You get that the amount payable to D after subtraction on the revaluation loss should be 50,700. And as you try now to balance, you see that the balances of R, so that they can equate to 91,000 on the credit side of the capital account, you have to have a balance carried down of 7,175, a balance carried down on what? The balance carried down on J of that 4,125, and as you can see, the figures have balanced off, with R balancing at 91,600, and on both sides, J on both sides at 73,000, and D on both sides at 54,200. So another aspect to consider is concerning the new balance sheet. This is the balance sheet now after the death of D. So you realize that buildings, we realize something when we consider this balance sheet. You realize the buildings, it was 50,600, property was 6,800. So you realize that these balances, we reckon now. There's something that you have to note, that we reckon now the figures that we are given after evaluation, not the previous figures. Now we reckon the figures that buildings were revalued. This is on the balance sheet. You reckon the new figures, but on the revaluation account, you reckon the difference. Get me clearly? For example, on revaluation account, we recorded when we recorded the difference. Maybe if is on furniture, that is 49,470 minus 40,000, we record the difference on the valuation account. But on the new balance sheet, you record the new values. And the values that we are given: buildings is 57,000, property and equipment is 17,900, furniture is 11,600, inventories is 40,000, debtors is 26,950, cash at bank. Cash at bank, this is now the amount that will be at bank by then. You realize that from our previous balance sheet, we earned cash at bank of 5,800. That amount will remain because it have not been altered by anything. So it will remain cash at bank of 5,830. On the liabilities and capital, on the credit side of the new balance sheet, we have creditors remaining at 15,450, account payable remaining, loans remaining, but a contingent liability. Remember, this is a liability that was proposed that it might occur, but it practically occurred. So it was recognized on the balance sheet. And the payable to D, this is the amount that you say that you have not yet settled to D. So that is the amount of 50,700 that as we have seen. And this is the capital balances. These are the balances that we have concluded on the capital account. These balances that we've carried down, these are the balances that are recorded on the new balance sheet, as you can see. And from there, we have to balance off the figures. But you realize as you are balancing off the figures, there is something that look not to balance on the debit side, on the debit side of the balance sheet. That is the amount of 6,000. This 6,000 is the amount that was the profit that was realized after those 3 months, and should eat the debit side because it was a profit. They should eat the debit side of the balance sheet. And now the balance sheet, the new balance sheet balances at 165,280 on both sides. I think that's all with what we have to look for today. Thank you.